Hello, Warriors. How's everyone doing today? Amira, hello, Amira. Shalom to you too. Brock, Karina, I'm fine. Hope you're doing okay. Didier, Kevin, good morning. Hi, Ren, Hugo, TJ, what's happening? And Sinatra. Richard Sabo, how are you? Okay, so when I was looking at the S&Ps last week, I really never dreamed that we would get back up to this level. Good, Richard. But I'm trying it up here because one of the things I use is a 2-week off number. And this week's 2-week off number, you just count back 2 candles, is 38, 39, 30. So, so far it's contained the rally. And this could be a big day because if you look at here's a day starting here. So, if we fail from here, and we have 1.618 of this, which was about 200 handles here, actually 220. You could end up with 3,400, 35, 34 and a half, or just enough maybe for a stop hunt under 36. So taking a shot up there. Also, I keep trying to bottom pick Euro pound. I just look at this, the way it's grinding out here, and how long we've been diverging. About 3 weeks since we had a confirmed low. So we really need to penetrate this 88.5 level. But looking at that, let's get back to the star of the week was silver. So classic way to trade a throw under was you wait for the first close back inside, right? So this $29 pivot was pretty good. Took silver all the way back down to important support here, and now it looks like a lot of people are thinking that we're going to go to new highs from here. Nowadays you can't rule out anything. But I'm thinking maybe we get some type of ABC. Should not really surpass 28 by much. And when I look at the weekly, even though we're higher here today, it's a pretty potentially ugly weekly candle. And, there are these things in Elliott Wave. There are these things in Elliott Wave called irregular Bs, where instead of having an A, B, C at a lower high, you could have a higher high. So I don't know. I'd have to ask an expert in Elliott like Greg if this is a possibility of an irregular B, and if it is, there's a C to follow. And if we have a fib extension of this, I could throw out a number that people are going to think I'm crazy, but if we have 1.618 of this, it would take you down to about $17 silver. So anyway, that looks pretty negative to me. Gold still looks negative to me. I still think that we're going to, trade under the 1700 handle. And I think what's about all I want to really cover. Oh, yeah. So yesterday I talked about the gold silver ratio. Look at this week that we're having here. So there's still 3 days left. And we're right here. I showed it. You could see it better on like a 4-hour daily, where we took out all this support. And we're trading right back at the breakdown. So again, the same thing I said yesterday, we start closing back above 68, it's going to negate this breakdown. And we did diverge at new lows from the lows that we had back here before we had a rally. So we'll see. Now we'll see what the Reddit guys could do after a $2.5, $3 break in silver, right? So we went from $30 to 26 and a half, 26.40. So we'll see what happens with that. The low in the gold silver is confirmed on all time frames. It depends on daily. No, I don't see anything there yet. But if this gives way, look out below. But we're going to get some type of retrace of this. So that's a big question. Are we going to get a retrace, or was this just another break to buy and we're just going to head back up there? So I don't know. It would probably take some help from the dollar, which I'm not showing the Dixie up here right now. But pound is trying to roll over. And actually, we're starting to diverge here a bit in Euro USD, and starting to diverge a little bit up here in US dollar yen. Let me just put up the dollar, and then I'm going to turn over to Blake because we don't have as much time anymore. What happened to my Dixie? Okay, here we go. Probably won't have the lines I had on it before. Oh yeah, it does. Okay, so anyway, I had this speed line here on the daily, and we're almost there. Okay, 91.40. So we'll see. This could be, some type of short-term completion of this stage of the dollar rally. So be careful with dollar longs now. And I think that's, let's look at Bitcoin. Yeah, good luck on that.
Ethereum's allowed to be traded on the CME now. So,
wow.
Yeah. What great timing, right? Just to take it to new highs.
Yeah. Well, I remember when they first brought futures contracts out on Bitcoin, it was when Bitcoin was what, 18,000? And,
was it really? Was it there? And then,
yeah,
I guess it came off pretty aggressively.
It was in December of that year just before it crashed. Yeah.
Yeah. So, it gave people, the people a chance to short it. Huh?
Means of an exit.
Yeah, because I don't think there was any way to short it before that. Maybe you could on the crypto exchanges. I'm not sure. But I remember saying last year, boy, these guys are salivating. They smell blood. That's why they're putting the contract out. I think it's different reasons this time, but
I do think I don't necessarily buy into that. But I mean, that they're looking to sell into it. I think it's just more of a trading vehicle now.
Yeah.
But yeah, I mean, cryptocurrencies have been really strong. But I'll let you finish up your.
I'm done, bro. No, go ahead.
Okay. All right. So yeah, it's interesting. Bitcoin was, as we were just talking about, Ethereum was just just allowed to be traded on the CME, and here's where Ethereum's at. That's the channel we were following. We were following this triangle, and it broke higher. So now, if you look at where it's at currently, whoops, wrong button there. You look where it's at currently. We're just kind of consolidating at the top of that channel now. So it's just kind of sitting here, right at the highs. But I if I was a buyer, I wouldn't be buying it right now. That's for sure. I wouldn't want to trade it up long up here. Not saying that it can't go higher. It's just, risk reward wise, it doesn't make any sense at this point. But speaking of risk reward, you know what I'm looking at today, Dale?
Aussie.
No, I'm looking at the euro. The euro is at an inflection point. This is huge. If you're wondering why the FX market is so quiet right now, I think everybody is waiting to see if the euro is going to break or not. I mean, that's really what it boils down to. You know, here, let me go over to the daily chart, do a little bit of work for you here. Let me remove this. Let me remove this. And as you can see, we had a wedge, right? We had a bearish wedge, and it broke lower yesterday. We closed below the 120.60. Now, a lot of people have been looking at this chart as a head and shoulder pattern, and you know, it doesn't matter how you look at it, really. It's head and shoulder pattern. You know, this is a, if you can take this blue line here, you know, this is a bearish wedge, you know, and regardless, we're breaking lower now. Based on what I see, based on what I see here on the euro dollar is going to break lower eventually. I don't know if it's today or not, but because you can do it a couple of different ways here. You can say, well, here's your head and shoulder pattern. It should target, you know, eventually 117.50. Or you can say, well, here's my bearish wedge. It should eventually break to 119, right? And I think the only thing that we're waiting on right now is to see if we're going to break 120 today or not, because it's going to be a cascading event. I mean, everybody who want, okay, let me ask you this. Who wants to buy dollars right now knowing that the euro is right on critical support? No one. It's kind of like everybody sitting around looking at each other in a Mexican standoff, you know, waiting for somebody to pull the trigger first. That's exactly what's happening right now with the euro, and it's a big support. If you read the blog yesterday, right here, if you just go to our website and you just go look at our chart of the day from yesterday. This is the euro, and I outline the reasons why the euro is so important at current levels. It really is. I mean, this is the breakout point, right? Whoops, dang it, I don't want to move that. Cancel that. You can see we have alarms set up all over the place on this, but you can see this is the breakout point, right? The 120 level. That high, that spike high, was 120.11. Today's low is 120.04. So obviously we're, you know, testing
right there. Yeah.
Right. We have this trend line that goes from May of last year, post-COVID, all the way to current prices, and we're sitting on it. So we know that if we break below 120, it's probably going to trigger some stops too. I know everybody that's long is probably got their finger on the sell button, and anybody who's predatorily looking to short the euro has got their finger on the sell button as well. You don't want to run out and just start buying the dollar CAD because you know that the euro is right on support. You know the euro could bounce from 120.15 where we're currently at and jam up to 120.50 again, and the dollar Canadian will probably drop back, you know, 30 pips. So, you know, it's like, okay, well, I'm not pulling the trigger on anything right now until we see a breakdown. So this is why it's so critical for the euro. And I can't, I feel that it's going to break down, and the catalyst could be equities. If equities finally pull back, I mean, the equities have squeezed higher because the last couple of days, the market got very short because, you know, the market got short on Friday. It was the end of month. Everybody was looking at the potential of GameStop, and, you know, Wall Street Bets really, you know, unwinding some positions. So I think the market got pretty aggressively short. And then, you know, we got a squeeze the last couple of days. Look, I thought the squeeze was going to last to the 50% retracement right here.
Blake, sorry to interrupt. We have ADP in about 15 seconds.
Oh, shoot. Okay, thanks. I'll just keep it on this chart. It squeezed a lot farther than we thought. But yeah, if we start to pull back from here, I'm trying to get to my data. Sorry, guys.
Webinar online.
Oh crap! What do we get?
Oh, big beat.
Big
174 versus 49 or 50 expected.
Stocks are going higher a little bit, but will they sustain? I mean, you know, again, you got a Fed that's going, okay, you know, good data, great. You know, maybe we can start adjusting monetary policy. I know they're not going to.
Was this jobless claims, guys?
Huh? What?
What was the news?
ADP.
ADP jobless.
ADP. It's for, you know, because we got the jobs report actually on Friday. So,
okay.
Yeah. So anyway, the Fed's probably not going to worry about anything until we start to see some inflation. But actually, we have Eurozone inflation data came out pretty strong. I don't know if that was overnight.
That was this morning, and there are a couple of reasons why it was strong. It's not the numbers are not as good as they look, but it was stronger. Yes.
Okay, so we did have some stronger.
Sorry for repeating myself almost on a weekly basis. What do you mean by good?
Yeah, I know what you mean. Carry on, Blake. Carry on.
Yeah. Again, but the thing is inflation is creeping up globally. So I mean, central banks may have to react sooner rather than later, especially if the economies are looking stronger. And you can see, you know, stocks just spiked up on a good ADP number. You know, we'll see if they moderate again. But I'm gonna leave it with this, and then I'm gonna pass it over to you guys to give you, you know, so you guys can go over what you're looking at. But I'm really just focused on the euro today. I think the euro's at a big inflection point. Like I said, I do think we're in process of breaking down. I don't know if that's going to happen today, but I know no one wants to pull the trigger buying the dollar right now. I mean, other than people just getting squeezed, no one's going to continuously buy the dollar knowing that the euro is right at current levels. I do believe that if stocks recede a little bit after, you know, we've got 2 days of a massive squeeze from, you know, the poor positioning probably at the end of the week. You know, we got a squeeze back. If we moderate from here and we start to pull back, then I think that might give the market, the FX market, the catalyst to start, you know, buying dollars. Or selling euros, and in this case, you know, would probably sell Aussies and Kiwis and Canadians at the same time. But again, I think we have to wait for the euro to show its true colors. You know, let's see the whites of their eyes first. But those are my thoughts for today. Remember, when in an hour actually from right now, we'll be launching phase 2. For the bias chart, and we'll be covering the bias chart there. For those of you who are wondering, you know, what happened to that, and remember to get the bias chart analysis, you can do one of two things. You can, you know, let's go over here. You can go over to where am I at? Here we go. You can take a trial of ForexAnalytix. It's only $1 for 10 days, or join the light version, because it doesn't matter if you're premium or light. You can listen to all the webinars, or you can actually visit our webinar sponsor, which is right here, ForexAnalytix sponsored. Go to Pepperstone Securities, open an account right here if you're outside of the US or Canada, and you can possibly get ForexAnalytix for free up to 4 months, depending on how much trading you do. So 2 months when you open your account, then you get another 2 months once you complete 500,000 traded in currency, which isn't a lot. So anyway, that's the way you can be part of the ForexAnalytix community and listen to the bias chart analysis. Remember, you can even start with the light version if you want, which is only $19 a month. All right, guys. Steve, Stelios, what are you guys thinking today?
Hello. Good morning.
Good morning.
What am I thinking? I'm looking at the euro dollar as well, like you are, because it's at such an important point. Otherwise, I think we're all waiting for payrolls on Friday. I don't see anything major happening today, but metal is obviously on my radar as well. but nothing really major for me. What about you, Steve? You looking at anything in particular?
No, because nothing has really changed since yesterday, technically speaking. We did get the continuation lower in the euro, and euro still feels heavy. Dollar still is rather decently bid. But no real response from equities yet, first of all, which is important, because if we want to really see a follow through in the dollar price, we absolutely need to see a continuation in the move that we saw lower in equities at the end of last week. The dollar is yet to actually, really move. So I'm not overly enthusiastic, with what I see so far.
So how do you feel about this euro, Steve?
It feels heavy. As I said yesterday, I think it wants to. After we got one leg lower, we got a consolidation within a triangle, flag, pennant. Depends on how you draw it exactly.
Right.
I think it should gun for probably like 118 roughly. So I do think it's going to produce some more, follow through to the downside.
Yeah, it does feel that way, and and if you guys are trading currencies, which most of you do, then you got to think about what that does to the positions that you're looking at or the dollar pairs that you're looking at. Which I think there's a lot of opportunity for the dollar to really squeeze. Remember, the market is short dollars, and it was the top trade of 2021 for every bank at the end of last year, which was only a month ago.
But by the way, I think they're going to prove themselves to be right. The only problem is that first they're going to take the weak hands to the cleaners.
Yeah, we'll go to 116 first.
Yeah, and then the market will be free to, in essence, do that again.
Sure. But anyway, hey guys, I'm going to let you take over, and Dale, have a great interview with Mark Newton. I'm going to be actually listening in. I always love to hear Mark's opinions. For those of you that don't know Mark Newton, he's on CNBC quite frequently, or at least he used to be there in person a lot. But he's really a pleasure to listen to. He follows a lot of if he's a super technician. But I love to listen to his work. So make sure you guys stick around, and I'll see you back on Face 2.0 a little bit later.
Thank you, Blake.
All right, thanks, guys.
Good luck today, Blake. Mark makes it easy.
Thank you, mate.
One more thing I want to say about the euro dollar. I think we can all say with certainty that we're not the only ones who can see that it's at pretty decent support. So you can bet that a lot of people are going to be playing the risk-reward trade to try and buy it here, with a tight stop below. So I think if we do break below here, the next like 40 or 50 pips are going to be pretty quick, in my opinion.
Yeah, and hey, Stelios, and Steve and Dale, I forgot to mention, there's a lot of talk with Mario Draghi forming an Italian government, but I just need to point out that has nothing to do with the euro, the ECB or the euro dollar exchange rate anymore. Doing whatever it takes now is going to be doing whatever it takes to save Italy, not anything else. But your thoughts on that?
Yeah, although since you mentioned that, Blake, I'm gonna, I'm repeating myself, and probably that's tiring, but theoretically speaking, central banks were created to be completely separate from government, and call it a coincidence or not, we've gone beyond the point that these lines get blurred. I mean, Yellen, Draghi, so on and so forth.
Papadimos, right?
Papadimos, yeah. Actually, that's a good point.
I think Draghi is good for Italian bonds, that's for sure. And we saw Italian yields drop quite a bit. But anyway, let's see.
Yeah, Stelio, I said yesterday, if you were here at that point, the fun part is that we're having like conversations like, oh, look at the yields, etc. I mean, last year the ECB absorbed 85% of the bond buying in sovereign bonds.
Oh.
And
From all
in many
countries?
and in many cases of southern countries, it was like about 100%.
So they're practically the Bank of Japan that's buying everything.
So they're practically the market.
Yeah,
Full stop.
That's
They're
just,
practically the market. Full stop.
I don't know how anybody can see this and not realize it's wrong. It just
Yeah, I
doesn't,
mean,
doesn't make any sense.
Yeah, it's not a market anymore. It's
Yeah.
not a market. I mean, a market is supposed to depict risk, right? And compensate you for like risk taking or whatever. This is not a market anymore. These markets are not markets anymore.
Yeah.
Any way you look at it.
Yeah. By the way, Sansi says Draghi's son works in London. I know he's a bond trader. Do you know that, right? European government bond trader.
Pretty sure he has no.
I think JP Morgan. I think, but anyway, yeah, that's
pretty
fine.
sure I would hire him if I was one of the big banks. I don't know about you, Stelio.
Yeah, definitely. I'm sure he has some good information.
No, I'm sure he's very capable. I mean, I would never imply that he has some information.
Anyway, bottom line is last night, Italian President Mattarella, he basically, he summoned Draghi and said that he has to suggested he forms a government. I have an Italian friend who months ago said to me, "Look, we have all these elections coming and going every 6 months or something like that. It's ridiculous. And there's no proper government. It's always coalitions fighting amongst each other." He said to me, Italians are tired of this. They need something. And he said to me, I think it was 5 or 6 months ago, he said, I forecast Draghi being prime minister and they're gonna bring him on to try and do something. He said, I'm not for it. I don't think it's right to appoint prime ministers without elections, but I really think they're going to do it. And lo and behold, they've done it. So
to be honest, Stelio, I know this is an unpopular opinion, but judging by what people choose in elections, globally, I'm talking about. I'm not, photographing somebody specifically. It's not that has worked out nicely lately, right? Yeah. It's not that I'm against democracy, absolutely not. But my point is that unfortunately, we've got to the point that the level of politicians, and we've talked about that multiple times in the past, is really, really low. I mean, comparing it to like previous decades, like the 80s or whatever, it just wants to make you almost cry.
Yeah. I just want to answer a question. Sean is asking, I said some days ago, I've been saying for a while, if we close silver above 26.50 on a weekly basis, I'd buy. I did buy. I wrote on the chat room, I actually tweeted about it, I think, as well. On Thursday in the morning, it was below 26. As soon as everybody was talking about the Robin Hood guys and the Reddit guys going into silver, I said, right, that's it. So I got in, so I am long, yes. And I'm looking to add, if we do get lower, I'm going to add quite a bit more. But yes, Sean, I'm in already. The other thing I wanted to mention, we talk about the Eurozone CPI. It came in at 0.9% year on year. That's up from expected 0.5 and up from last print, actually last quite a few prints at minus 0.3%. That was higher than expected, but we have to note that there's some temporary factors for that. So there was a reduction in German VAT, and they reversed it now at the start of the year. So that's going to affect CPI higher, obviously. And,
temporarily, of course, because within a year it's going to be phased out, because it's going to be, comparing to last year, that effect goes away immediately.
Yes, exactly. So temporarily is there, and also there were in several countries the seasonal sales were postponed because shops were closed, so they were actually done in January. So that also takes effect. Still, we shouldn't disregard the number. It was better than expected, but it's not like this huge number that we have to, buy euros straight away. I don't think so.
And something, Stelio, I think you just referred to, in my opinion, what is currently the most popular fallacy out there. The most popular fallacy out there, Pavlovian response type of fallacy, is higher inflation positive for the currency. Why? Because central banks should respond by raising rates. First of all, I need to remind people that historically, inflation worked oppositely, and for every good reason. I mean, higher inflation meant weaker currency, right? and then we got more of the effect that higher inflation make after Volcker. We got mostly the effect higher inflation means higher currency. Why? Because the central bank is going to forcefully intervene, right? Raising rates, which means that it's going to strengthen the currency. I think that now wrongly the market expects that we're still in the same era that we were, meaning higher inflation will mean a response from the central bank, will mean strengthening of the currency. I think we've gone, and they've told us multiple times, we've gone to a new era. Higher inflation will be responded with doing nothing, but trying to, at least for a period of time, but trying to explain to us why it is a good thing and why, as they had told us in advance, their target now is symmetrical. And since we had lower inflation, higher inflation is a good thing because now we're averaging, the previous low inflation.
Yeah.
So I think that at least for a period of time, higher inflation is not going to lead to rate hikes, and it's not going to lead to currency strengthening. Quite the opposite. Once
Very
everybody
quickly, since we're a minute, I think Mark is here.
Mm-hmm.
Stel, you have any feeling on BOE for tomorrow?
Well, I have no reason for them to give us anything different than recently. There hasn't been. It's still only a month since Brexit, so there's not really. I don't think we'll see anything different. That's my quick.
Okay.
Yeah, logic says it's going to be a non-event. Yes.
Okay. Appreciate it, guys.
Thank you.
Okay, so here comes Blake's favorite technician on CNBC.
Dale. For some reason we forgot to say it, so please give me a few more seconds and you can take a little bit longer the interview. We've actually implemented, guys and girls, the live squawk ability. So if you go to your newsfeed on ForexAnalytix, now you see it's online and playing. What it's going to be saying in your case is that you can start your live trial by clicking here, and you then get 10 days of this without any charge, and you're not even automatically getting charged afterwards. You need to choose to do it, manually. So the live squawk feed is up, running. So those of you that are members of ForexAnalytix, go ahead and give it a try. You have nothing to lose. Thank you, Dave.
Otherwise, just become a broker and you'll hear live squawk from your customers every day. We hear some live squawk, don't we, buddy?
Oh, absolutely.
All right.
Okay, enjoy the interview with Mark.
Steve.
Looking forward to hearing what he has to say.
Okay. All right, Mark, I'm getting you set up. Happy New Year, Mark. See your screen, buddy. Waiting to hear
you're still muted,
voice.
Mark.
Okay, I'm unmuted now. Hi, Dale. Hi,
everybody. You're good.
Hey, hi, happy New Year, Mark.
Yeah, likewise.
Hey, Mark. Welcome back.
Yeah,
good to have you. So, okay, what are we going to start with? Looks like some cycle work and S&Ps. Before we get going, you're still looking for maybe strength into late March or April, and then the cycles turn negative.
Yeah, I'm not sure if we're going to be able to make it that far without at least correcting a little bit of what we've seen. I think this, we've seen a level of sentiment just getting very dramatically enthusiastic, a lot of speculation, as we all know these days, of what's happening, and just a lot of complacency. I think equity put to call has gotten down in the lower 30s. I think that's interesting. Moving averages have reached the lowest level we've seen in over 10 years. So, what I see that's interesting is the fact that we have started to break down in a lot of different, let me see if I can share a different screen, and that might make it a little easier to share.
It's an interesting trend line that we're tagging that you had up there.
Yeah, I want to share this real quick, and then I think it's just interesting
There you
that
go.
so when you look at things like the Dow Jones transports, it's pretty interesting that we did in fact break the entire uptrend since March
Yeah.
as of last week. And so yes, we did hold where we needed to, but we do have quite a bit of negative divergence now. So not to be too negative, but there are some things happening, I think, under the hood that are somewhat interesting. On a weekly basis, you actually have weekly MACD is now starting to roll over for the first time also. So leading sectors like the transports and the stocks obviously are showing some evidence of getting very overdone, and the patterns in the short run are not necessarily all that great. So I was a little negative after last week, and I think what happened yesterday did officially clear that up to some extent. You could argue that the bull market is back intact. You just wonder. I still have to wonder what the shape of this wave structure is. I came into, I think, the last couple of weeks thinking there were four main things that were a problem. One was that momentum had started to show evidence of waning. Breadth had done that in the last month. We saw the summation index, McClellan summation, actually peak out in the month of December, and so you did have some evidence of waning breadth and momentum. Sentiment had been very optimistic. We started to see a lot of the cycles that I track show evidence of peaking out actually in late January and showing a secondary peak right around the 16th to the 18th of February, and then turning lower into March. And then we actually bounce into April. And the period from April to September really should be the meat of any sort of real decline. And so, we'll see what to make of it. I think it's interesting that the dollar really starting to show evidence of moving up, at least by the Dixie. That's
Yeah.
interesting, and something that many of you likely have highlighted. But this pattern, we saw, I thought, a pretty large level of bearish sentiment, and now we're seeing evidence of that starting to push higher. So, we'll see the extent of what happens here. But we could easily see 91.5, 92 before you sort of slow down. And historically, that's been sort of a negative for equities. So,
Yeah, one of our attendees is saying that because you use Ichimoku on your charts. You've been using that for a while?
I do find it fairly useful in terms of providing, support and resistance that might ordinarily not be seen. And so,
Right.
certainly that's something to watch. So it's interesting now because you have yields showing evidence of pushing back higher along with the dollar. So that should actually be, a pretty big negative for precious metals, actually, and for commodities. So that's
What do you think of? Yeah, what do you think of? The big debate was after social media, Reddit, and those guys were successful squeezing a small cap GameStop, and then they decided to turn their sight towards silver. And it's a much larger, deeper market than a small cap. It's a global commodity market, and retail was already long silver going into it. I don't think there were enough shorts to squeeze. Pretty negative day that we had yesterday. Almost a negative week if we finish down here.
Yeah, the one thing I would mention is that gold really didn't show any type of real strength, and it really diverged substantially from what silver was showing. And so,
for a while,
I've always been taught that if the dollar is pushing higher and yields are pushing higher, then it's going to be a very tough time for the metals. So, we'll see. I think the silver chart obviously looks a lot better structurally than what you see in gold. But yes, you certainly have some work to do. And as you mentioned, CFTC data showed the
retail
large
already
speculators
long.
were very long, and the commercial hedgers were pretty short in the metals right now. And so I think markets like silver are very tough. The Hunt brothers learned that the hard way. When you
I remember it.
go after a market, and the regulators aren't going to stand for it. They raise margins pretty quickly, and that will tap out the speculation. So Yellen is meeting, I know, with the SEC, and they're going to try to, I'm not sure what's going to happen and what's going to result in all of this. I think, you might end up seeing a time when the uptick rule is reinstituted, and also they might do something with regards to regulation. But, there's nothing wrong with a group of people discussing things that they like. I think if you start to show evidence of collusion, that's obviously a different story. And, I don't think they can.
Yeah, how
I'm
could
all
they
for free
regulate
markets
social
and
media from everyone collectively deciding to put their buying power together? I don't know how that could be regulated.
People are selling synthetic puts, short. It's funny. You take a look at selling things under parity when a lot of these people were trying to sell calls on GameStop, and they really had absolutely no idea as to how options work. And that's my fear, is that you have a lot of new people into this market that don't understand option pricing and how to even price out calls versus puts. They just look at it as a cheap way of making money on a stock by buying a ton of upside calls and watching it work. And they don't understand the deltas. And, gamma hedging, I think, is a little far-fetched. I used to trade equity options on the floor, the CBOE, and there's
Right.
plenty of things to hedge. If I'm a market maker and I sell 1,000 lot of calls, I can hedge that in a million different ways. I don't necessarily need to buy stock. And by having short gamma, I used to be able to trade that. It doesn't necessarily cause the kind of problems that the media would have you believe when they said, oh, it's a gamma squeeze and things are, the train's coming off the rails. And it, it's important to understand, but certainly, look, an unprecedented level of volatility. I don't view it as all that healthy that people that are really not knowledgeable are coming in and trying to, thinking that stocks and everything else are moving in, ways that they can control. I think that supply demand eventually wins out, and they're going to learn the hard way that, at any rate. So yeah, I'm not really. I don't have a lot of strong conviction in the metals. I tend to be thinking that we're gonna have a move to the downside as yields in the dollar rise.
Okay.
The VIX is interesting. You've had some evidence of trying to bottom out, and now you're pulling back to levels that, I think in the next 2 weeks, if the VIX continues to fall, that's going to set up for a very good opportunity to buy vol, headed into spring, summer months. So,
Okay.
I'm
Under 20, you think? If we get under 20, think that could
I
happen?
don't know that we would take out the lows of December. That would be really an unprecedented. But I think you can certainly retest. Well, not certainly. I think that look, if the market's going to press higher, then I do think vol could settle down a little bit. And I would certainly look at buying VIX call spreads. I'm looking out in June, and also if you really want to speculate, you look in March and buying $20-$30 call spreads for under $1. I think that's a home run. It's a great way to. It's a way that I'm using to sort of hedge portfolios, but I'm also keeping very tight stops on longs.
Okay. What else, Mark?
What's interesting is that the FANG area has sort of come back to life when we've seen
that
of late.
It went to sleep for what, about 2-3 months, and then the last few weeks here they started the rocket ships again.
Yeah, let me try to share this screen if I can, and let's just look at something else. So, this is Amazon, and this literally had gone nowhere for a long period of time, and then it sort of broke out prior to earnings, and now it's settled a little bit. It was trading higher, and now most of these have come in a little bit. But most of the FANG group, you just can't really. Facebook is probably the weakest of those, where you say that truly, and Google obviously is showing very good gains today.
Yeah.
Netflix, so most of these have gone sideways, but equal weighted technology, has largely been flat since the spring. We've have had pockets where this started to underperform into January. Now this picked back up. This is an equal weighted ratio of just the RYT to the equal weighted S&P, the RSP. So it strips out a lot of the large cap dominance. And I view it as being, when you see the lows of this broken, that's truly going to be a time to think that, a bear market has begun. If you take out September lows in most of the FANG stocks and large cap technology, then that's heading into a tough time. But, I think it's interesting that you are seeing pretty good strength in emerging markets, even while the dollar has been pushing up. So this is just a ratio of emerging markets versus the developed markets. And so,
That is interesting.
small caps has started to wane a little bit, relatively speaking. I'm keeping an eye on that only because I do think that that's how bull markets end, is by small caps
Ma-
starting to roll over. Yes, sir.
Mark, if I if I may ask you a question, I know that you're mainly a technician and an excellent one. I mean, there's no denying that. I would want to hear from you your fundamental thesis about things. I know that fundamental theses don't have a time frame because very frequently the market might take a long time until it actually plays out to what makes sense. But you're always like giving us an excellent outlook on what you think is going to happen in the market, and you're way more frequently right than wrong. But I want to hear your personal fundamental thesis, if that's okay with you.
Well, I look, I only got to level 2 of the CFA. I found out the hard way that, you don't highlight with a black magic marker. So, I never got my official badge, but I went into the technical analysis about 20 years ago and never went back. I'll say that, I feel that the Fed's ramping up the balance sheet has fueled this rise in assets. Personally, it has created a lot of the inequality that has caused, a lot of the unrest that we see, and that's going to take a long time to unwind. I think largely the earnings have come in better than expected. I think it's been sort of a home run. I was frankly shocked, as I think many people were, that the markets could be as resilient and the stock market could really avoid the downturn in the economy. I still view the economy as being at a very weak level, and we're not going to
Of course, we have to take into account that for the economy to be window dressed, globally, we had to accumulate unprecedented amounts of debt within a short period of time, right?
Correct. I obviously have personal opinions on this, and it doesn't mean that I'm right. And so it's always tough to quantify fundamental thoughts because people are biased in their opinions. I would view, it's going to be very difficult to continue to ramp up spending to the degree that the new administration is doing without causing real problems with the deficit. And I just think already that there's only a certain amount that we can spend our way out of this. And so, that's my personal thinking.
Yeah,
I think
and
that's
the
going to come
scariest
back
part,
to roost where
it's
been done since the beginning of time, but the key is if yields start to ramp up dramatically, I think that started 10 years ago after the last decline from 07 to 09, and during Obama's presidency, and I think productivity we really started to ramp up spending on entitlements, and that really crushed our productivity. And then, the US has not been able to grow at larger than 2% for a long period of time.
If we believe the 2%, because my personal belief is that the GDP growth is also globally window dressed by the simplest mathematical method, which is masking a lot of the inflation, which, as you very well know, it's the last mathematical thing you put in the equation, meaning deflating nominally what you have to compare it to last year. So I think that at least part of the growth is understating last year's inflation. Anyhow, I'll let you go back to.
Go ahead, wrap it up.
Interesting, and I think that in general, it's tough for me and all of us that look at the market on a day-by-day basis to really truly understand when that's going to become the tipping point and looking back and what caused it. But I do think that the debt is out of control. The balance sheets are very bloated. I think when they start to dial that back, the market's likely going to turn down. I think that inflation might not be a big deal for a couple of years. If you look at the longer term cycles,
absolutely,
2025, 2026 as being the time of inflation, not really right now.
What scares me the most, Mark, is that now it has become a consensus that debts and deficits don't matter, which is so weird, right?
Well, I think that's always been the case because we've always, there's a certain group of people that always say they do matter, but in retrospect, we've always been able to spend our way out of it, and it's been fine. And the market's rebounded, and that's helped the economy, and things have snapped back. But I don't know if that's always going to be the case. At any rate, yeah, I don't know how to debate fundamentals only because, a lot of it depends on how you view the economy and whether you believe in the supply side economics and how to really fix things when they're broken. I just don't know that we're going to be able to grow the economy and have a robust second half. I view this time in the first half as a time when markets could in fact peak out. Before you see the GAN mass pressure index on the bottom part of this chart, and I think this is interesting.
Yeah, what is that, Mark? I'm losing your volume a
this
little
is
bit. The
this is an
GAN mass pressure. What is it?
So this is an overlay, Dale, of 60, 40, 30, 20, and 10-year cycles, all on top of one another. So you look at, and going back over time, if you take all these longer term cycles and overlay them, then this tends to approximate, and it's very uncanny the way that, you come into certain weeks and the market just turns down and people don't have any idea. And then you go back 20 years ago and you say, oh, look, the market peaked at exactly the same day, or look at 30 years ago, or look at 40 years ago. And so this actually shows a peak for the market right around the 11th of February of this year, a move straight up. It shows a choppy period, but really a down bias into March, which I think we have. And then rallying up into April, and then this period from April to 15th, really into September, should be the correction.
Okay. Yeah, that's what you were talking about last time, only this time we have a visual on it. So, yeah, nice, Mark.
So this is interesting. We'll see. Last year it worked out very well, and we had a decline into the spring, and then it rallied literally all year long. And so,
right.
We'll see if that matters or not. But I do view us as really approaching sort of an important time. It's going to be tough for us, the S&P, to get up above 4,000. And as you get into, I think the middle part of February, the combination of, the attempted impeachment, I don't think will sit well and could in fact stir up further unrest. And I think that the cycles, we really got our first dose of things turning down last week. And while the equity indices have rebounded, a lot of the momentum has not. And that's really...
Speaking of doses, Mark, what's your view on the vaccination personally? Are you looking forward to having it? Are you going to pass? What are you going to do?
I had COVID in October, and it was a very quick recuperation for myself and my son. And so I've known a lot of people that have gone through that, and it's an unfortunate experience for a small percentage, and a lot of people tend to recover very quickly. So, I don't see the need for myself to have the vaccine, probably at least until the summer. I sort of want to wait and see how things all play out. And so
thanks for sharing
I think that we're largely past the time of real peril. I think that there's millions of vaccines out there available now, and it's just you just have to figure out how to get it. And so I think that by March we'll see that this is largely I think we'll have the path to recovery in my own view. So I don't know.
Isn't that funny that during this whole process the market's going up, and when you think the path to recovery on COVID will really begin to take shape is when the cycles start to turn negative again. As people stop worrying about COVID, maybe they start worrying about the economy.
I honestly never give people credit for being able to really have that much effect as to being able to manipulate markets. I don't believe in a small group of people at the bottom buying and at the top selling. I think the buying dries up. So people being worried about COVID, that's been intact for a year, and markets have been able to rally right through that. Just like people were concerned about Trump's rhetoric, and it didn't have any effect on the market. So I think that people invent things to be concerned about, and yes, of course they're right, but it's more, does this affect stocks in the way that we all think it should? And I would argue, absolutely not. So, this is what happened the other day. We saw markets rally up through 3780 in the S&P. So for me, that's certainly a very big area. It's tough to make this as a 5-wave decline. It's, to me, it still almost looks like a 3 unless you count this as being, it'd just be very strange looking. So, you know, I don't know. I think that this is a little choppy range we've been in since this time 24 hours ago. Many people think the market's gone straight up. It's actually been sideways since this time yesterday morning.
Yeah.
So yeah, getting
So
up
what
above.
are this grid? What's it represent to you?
The
Is
grid?
it time?
Oh, I'm
grid.
sorry. You're not even.
Yeah.
I'm sharing the wrong.
Oh, okay. Yeah. So we're on
I
that
apologize. Let's see.
S&P with the
Let's
grid.
see,
All right.
So here's the S&P. This is what I wanted to show you. Is that
Okay.
here's the decline that we saw last week, and it's tough to really make this into a 5 in my view. It's most likely still a 3. And here's our 3780 level that we broke out. And here's in an hourly chart the last 24 hours. So yes, markets are rebounded, but it's, you know, most of this happened from, you know, the 31st when we bottomed, and obviously getting up through this acceleration yesterday
Could
morning.
this be a B wave ending here? And just like the first break was an A, B, C for A, and this rallied B, and we have
Well,
C to
it
the
would be an
downside?
sure. Yeah, I think that if you put this as being a 5 here, and this is a, you know, A, B, C, then this is a 5-wave C. But, you know, at this point, we have seen sufficient rolling over in a lot of things. So I just really want to try to just keep a very close eye on any move that gets down to, you know, towards recent days low. Here's how I view the S&P, and using Ichimoku, you can see that we actually bottomed at a level right where we needed
Look
to
at that.
at 3750. And so this is really an area of concentration for me in terms of, can this market, you know, continue up or not? We could easily pull back and then have a final push.
Right.
But
Right.
you know, we're in an area where it's going to be a lot choppier. And if anything, the momentum has really started to, you look at what's happened with RSI dipping down to the lowest level since November. You have seen a rolling over in MACD. So, of
Caution.
course, the FANG stocks have certainly rebounded. I don't disagree with just reducing risk, you know, over the next 4 to 6 weeks, and think that we likely are going to turn down between now and March, and then any sort of rally out of that, you know, should really be something to consider selling into.
Okay, Mark. So, oh, you want to show crude? Yeah,
I
crude.
just think, you know, it's pretty interesting that we managed
Yeah.
to really snap back yet again and rally out of that.
It had
copper-
the risk off last week had no impact on crude, which is somewhat different.
Yeah, we sort of churned, but you know, you could make the same argument with S&P. We did see daily weakness, but we didn't see weekly weakness. And so, you know, for me, that's the main thing is by, you know, this is, you know, you want to see S&P truly, I would argue, you know, let's see some evidence that this matters. Momentum is certainly starting to wane a little bit, but you know, I'm not one for having a real need to have to pick the top. I think, you know, I have plenty of stocks. I'm happy to make money as stocks go up, but there are certain risks in the market now that certainly weren't present. What I'm looking for specifically is a sign that defensive sectors are coming back, and we did see some evidence, a little bit of that a few weeks ago, and then largely that's disappeared as tech has roared back. And so when you see complacency, breadth, and momentum rolling over, seasonality, you know, that's important. I think, you know, the cycle stuff that I looked at all really started to turn down. You know,
Last week.
Maybe I can show a little bit of that real quick. Let's see if I can. Yeah, while we have it, let's see. This is interesting. You'll like this.
Community's thanking you for your great analysis, Mark.
So yeah, I just okay. I'm going to stop sharing on the one, and I'm going to try to reshare on this other screen that will show you
Dale,
Yes.
a few things. Any questions in the meantime?
you can definitely take another 5 minutes. It's not a problem.
Okay. Thank you. All right, so let me just, I'm going to stop sharing here, and I'm going to reshare on this other screen right here. Okay, so Here's just a weekly chart of some of the most prominent cycles that we've seen in the last 100 years. And so this pink line is where the composite starts to turn down. And so we saw that back in 2000, really right at the top. We saw it back in 07. We saw it in 2014. Of course, markets didn't go straight down, but they did go sideways for almost 2 years, and we did decline about 10 to 15% from the top. And now they're actually turning down again from now into late 2022. So the amplitude is shown in pink. It doesn't mean we have to retest the lows, but this is a pretty prominent turn. And I looked at this going back since, the mid 70s, and you do see, this worked very effectively during times like the mid 70s debacle when we declined almost 50% down to the lows in 74. You look back in like 1929. And so I rate these cycles based on strength and Bartel score. And for me, this is a pretty prominent year, and I think it is going to be a down year, but I think it's always tough to break the back of a bull market. It does take time. And so technology really should be, the key in all this in terms of, but I just want to show an overlay of how this looks in 2000 and 2007. And so now it showed. And the daily cycles actually were pretty accurate in showing a peak last year and then rallies. And so, I don't know. I think that it could set up to be an interesting year. The mark stuff is literally all lined up at this point based on a weekly chart. And let's see if I can show this. Can you see the this is a software called Symbolic by
We've got the DeMark up there. And Google now, Google Weekly.
Oh, it's not shading. Oh well, we don't have to cover that this time. We'll do that next time. Yeah, look. So I have any further questions? I'm happy to take them. But I think this next couple months is going to be a little choppier, I think, than most people think, even though we've rebounded the last couple days. And technology is obviously going to be very important, but just keep watch on momentum, because as this S&P chart shows, momentum in transports and many of the popular indices has really started to roll over a bit, specifically because of last week's sell-off. And so you want to keep a watch on weekly lows and
Appreciate you, Mark, and coming in. What's the best way for people to follow you? Of course, on Twitter, they could follow you at Mark Newton CMT. And how about your website?
Yeah, so I run a service called Newton Advisor. I provide technical analysis to institutions, but also to individuals. And let's see if you can send an email to info@newtonadvisor.com, advisor with an R, no S, or just go to newtonadvisor.com. Happy to put you on a trial of my work. I put out 2 pieces a day and reports every weekday. We do webinars every Thursday around 1 o'clock, and I do a very intense dissection of all markets, be it equity, commodity, currency, treasury, and happy to see if my work can be of help to you.
It is every time you come here, my Trading Warrior brothers. Thank you so much, Mark. I'm hoping this is one of your better years here in 2021.
Yeah, no, I appreciate it. I think it was a tough year for a lot of people in a lot of ways, but financially, I think I was blessed. I had one of my best years ever. I was up over 250% last year, so I'm hoping to replicate that.
Wow.
We'll see if we can do it.
Yeah, I'm calling the Guinness Book of Records right now for you. So congratulations on that. And thanks again, Mark. Let's get back together in the spring and see how things are playing out with this dominant GAN cycle. Okay?
Thanks, everybody. Take care. Have a healthy,
Mark Newton,
happy
everyone.
rest of the week. Take care.
All right, that's a wrap, Steve. So remember, don't just count your pips, count your blessings, and don't forget to join Blake and the team in Face 2.0 for the bias chart and the rest of the team's analysis that they'll be batting around the markets. And we'll see you guys tomorrow. Good hunting the rest of the day. Thanks, Steve.